What happens to Treasury bills if the government defaults? Have you ever wondered what could happen to your Treasury bills if the government were to default on its debt? It's a serious question, especially for retirees who often relying on these low-risk investments for steady income. Let's break it down. Treasury bills, often called T-bills, are short-term debt securities issued by the United States government. They are generally seen as one of the safest investments because they are backed by the full faith and credit of the U.S. government. However, if the government defaults, meaning it fails to meet its debt obligations, the situation changes dramatically. In the event of a default, the Treasury Department may not have enough funds to pay all its bills on time. This does not mean that all payments would stop immediately, but the government would need to prioritize which obligations to pay first. Holders of Treasury bills might face delays or reductions in payments, which could disrupt the expected safety and reliability of these investments. For retirees, this could lead to several important consequences. First, there might be payment delays or losses. If the government delays payments on Treasury bills or pays less than promised, retirees who depend on this income could experience interruptions in their cash flow. This is a significant concern for anyone relying on these funds for daily expenses. Second, a default would likely increase interest rates. When the perceived risk of U.S. government debt rises, new Treasury securities, including T-bills, would offer higher interest rates to attract investors. While this may seem beneficial for new investors, it would reduce the market value of existing T-bills with lower rates. This could lead to losses for retirees who might need to sell their T-bills before they mature. Additionally, a default would cause market disruptions. Investor confidence could be shaken, leading to volatility in financial markets. Retirement portfolios that include Treasury bills or funds invested in government securities could see sharp declines in value. This could significantly affect overall retirement savings. Lastly, the broader economic impact of a default could lead to an economic slowdown or recession. This might increase unemployment and reduce income for many retirees. Federal programs that support retirees, like Social Security and Medicare, could also face funding challenges or delays. In light of these risks, it's essential for retirees to understand that while Treasury bills are typically low-risk investments, a government default could compromise their safety and reliability. Those who relying heavily on Treasury bills for stable income should consider diversifying their portfolios, including other low-risk assets that may be less affected by a government default could help protect their retirement savings.